I'm Stan Humphreys. I'm Chief Economist for Zillow, so I'm equally delighted as Spencer to be doing this forum with the Bipartisan Policy Center. We're really delighted to have this great lineup today that we have. It's my pleasure to introduce our midday keynote speaker, Commissioner of the Federal Housing Administration, Carol Galante. As FHA Commissioner, Carol has had direct responsibility for oversight and administration of the Federal Housing Administration's $1 trillion insurance portfolio, which includes single-family as well as multifamily housing. Before taking her role as the FHA Director and Commissioner, she was also responsible more directly for multifamily initiatives within the Federal Housing Administration. And under her leadership, the Office of Housing has developed a comprehensive risk management framework within the FHA, which has been very important for their long-term strategy. She's also responsible for several of HUD's rental assistance programs. Prior to her current role at FHA, Carol served in a number of roles, both in the public, private, and nonprofit sectors. Of particular note, I will add, Carol ran the Bridge Housing Corporation, which many of you may know was the largest, or is the largest, nonprofit developer of affordable, mixed-income, mixed-use housing in the state of California. So she has a rich history in both government, private sector, and nonprofit, which has really served her in good stead at the Federal Housing Administration. Carol has been a long friend of Zillow and has participated in prior housing forums. In fact, I think it was last year that Carol spoke at our West Coast conference that we did in partnership with the University of Southern California. At that time, Carol's beloved San Francisco Giants were headed to the World Series, which unfortunately is not the case this year. So she's probably a little bit unhappy about that, but we are pleased to welcome her to the podium today to talk about what's going on with the FHA. So please join me in welcoming Carol Galante.
Thank you, Stan. So the San Francisco Giants may not be going all the way, but I still have hope for my beloved 49ers, so we'll see. Go Seahawks, sorry. Oh yeah, I forgot, it's a Zillow crowd. So good afternoon, it's great to be here, and I do realize that I am standing between you and lunch, so I hope to not take too much time and make sure that we also have some time for questions. It's a pleasure to be here, and I really want to thank Stan and all the folks at Zillow. What he did not tell you, because I really shouldn't give commercials, and I know this is webcast, and so this is not a commercial, but I do travel with my Zillow app on my iPhone. It drives my husband crazy when we go on what he calls busman's holidays, because I am looking at real estate prices wherever we go, in whatever city, whatever rural community. I've got my Zillow app out, and I am checking out the real estate. So that is just how committed I am to the real estate world, but also how much I enjoy the Zillow product. I also want to thank the Bipartisan Policy Center, and I know Pam's here, not just for inviting me to this forum, but for the work that both Zillow and particularly the Bipartisan Policy Commission has done with their recommendations on housing finance reform. I think it really has started and helping the continued dialogue around housing finance reform, and it's a very important role to get us all started down this path. So we all know that housing finance reform is necessary to ensure that our economy emerges stronger and more secure from the worst recession since the Great Depression. And this has got to be one of our top priorities in this country. And so before I get to that, I do want to say a few things about the government shutdown that just ended. Interestingly enough, I was at a forum on housing finance reform the day of the shutdown, and I was only allowed to be there until noon so that I could go back and actually run the business of shutting down the government, which was no fun. But we've been back to work a full week now, and I have to say we are still recovering from its effects, and it will take some time. And this is a situation that was entirely preventable. And so the last thing that the housing market needed, to be frank, was more uncertainty of a prospect of government shutdown and a debt ceiling breach. And the government shutdown clearly had the potential and the debt ceiling breach to destabilize financial markets worldwide and negatively impact our very fragile housing market here at home. And so to think that we might go through this type of thing again is simply unthinkable. The shaking of the confidence in the housing market and the economy is something that we just can't have. We need to get on with the business of housing finance reform and other important priorities. We had, during this shutdown, important housing counseling grants, for example, that we could not process. Our staff is still digging out of 16 days worth of backlogs of requests from lenders, calls to the FHA Resource Center. We had a very limited number of staff on board to process loans, but there was a lot of activity that was not happening. There was no lender quality assurance going on during this time. I had no risk management people. I had no insight into the portfolio or our applications during this period of time. So, these delays were serious. They impacted FHA, but more importantly, they impacted and hurt real people across the country. To say nothing of the $24 billion that Standard & Poor's estimates that the shutdown costs the economy. It also costs in uncertainty. So we can't continue to govern from one crisis to the next or pass the buck and hope someone else is going to do it. We have many challenges in front of us in this country, and we need to remain on the job to take care of those. And again, for those of us who are really involved in housing in whatever level, job one really is to keep the housing market recovering and to create a safe, secure, and transparent system for the future. So I know that's what you all are here talking about today, and I would like to just contribute a little bit to that dialogue, and I want to start with the role that FHA has played during the crisis and talk about housing finance reform more broadly, and then how I see that as we build that new finance system, where FHA fits in the future of that new system. So obviously, FHA has a dual role in our housing market, and I think it's really important for people to understand that we do have a dual role, ensuring access to credit for qualified borrowers of modest means, on the one hand, and bringing stability to the market during times of crisis. And the recent recession clearly demonstrated that the countercyclical role that FHA has played is vital to the market, and we had to play it in a bigger way than we had ever had to play it in our history since we obviously were created after the last Great Depression. So during the recession, FHA's market share increased almost 5 times, keeping credit flowing when the private market collapsed. And let's be clear, FHA did not chase market share during the ramp up to this crisis. We were at 3% market share, but we ramped up when private capital totally receded and there was no availability of capital in the market. So in the last 5 years, FHA has helped more than 7 million families buy or refinance their homes. And by supporting the nation during this worst financial crisis since the Great Depression, we did exactly what we were designed to do, which is stabilize the housing market and ensuring liquidity while preserving access to credit. Now, while the government guarantee that FHA provides expands access for borrowers not well served by the private market, its counter-cyclical function obviously protects and stabilizes the market for a much larger portion of borrowers than it does during other times. And again, this role was part of FHA's design, and we are equipped as a government agency to stay in the market when the private sector may not, which clearly reduces disruptions and helps to stabilize the markets going forward. But playing this role requires a difficult balancing act. I often say, you know, I feel like I'm on the knife's edge every day, ensuring access to credit and stabilizing markets on the one hand, while on the other hand, mitigating risks to the fund as we are going through that counter-cyclical role. So it's a very difficult balancing act to play, and we take the responsibility of this balance very seriously, which is why when this administration came in, we sought throughout the continuation of the crisis, so to speak, starting in 2009, to take very aggressive steps to protect the fund and improve the health of FHA, but in ways that did not restrict credit for American families or slow the recovery. Not an easy balance to maintain. Many of the changes we made, like increasing and adjusting mortgage insurance premiums, helped to properly and effectively account for our risk. Within the limits of our authority, and I'm going to go back to this, we made great strides, but there was only so much we could do with the authority that we had. Despite these efforts, and I know you all know this, the reality is that we were forced to play an outsized role after this great recession, and that carried costs. And I'm sure you're aware, FHA took a mandatory appropriation of $1.7 billion to close out our fiscal year 13 on September 30th. Now, the mandatory appropriation should be understood for what it was, an accounting transfer to close out the fiscal year of the 2013 books, not a reflection of the MMI fund's current performance or its ability to pay claims. Today, FHA has almost $50 billion in liquid assets, which includes more than $17 billion that we earned during fiscal year 13. Secondly, the portfolio has seen dramatic increases since the budget reestimate, it's called, was done this time last year. Even since last year, 15% drop in delinquency rates, down to a low of 7.98%. For seriously delinquent. 20% drop in foreclosure rates, 26% improvement, 26% improvement on our recovery rates, which is huge, and more than a 90% improvement in early payment defaults. So these improvements are a direct result of the actions this administration has taken to strengthen FHA and strengthen the housing market as well. And the things that we're doing now to help the housing market turn the corner, we've contributed to that through all of these actions. So FHA is an investment in the success and the stability of the housing market and the middle class. And by using the lessons learned during this crisis, we're taking steps to continue to support both. As a result of the crisis, access to credit was severely constricted. In spite of what FHA was during this period of time, you all know it has been harder to get a loan for your average American family these past few years than is necessary. First-time home buyers currently make up less than 30% of the housing market, where that's typically closer to 40%. So I just want to mention a couple of quick things that we are doing right now as we're transitioning to a broader housing finance reform. There are things that FHA needs to do right now, just like there are things that FHFA is working with the GSEs on. But the most important task that I am engaged with right now at FHA is providing greater clarity for lenders so that it will encourage expanded access to credit and help more borrowers and help the market recover faster so that FHA can return to serving well the core underserved borrowers that is part of our long-term mission. The first step in this, and this is not a sexy thing to talk about, but I'm just going to mention it. The first step is to update and substantially improve our single-family handbook. Now, who really wants to talk about single-family handbooks? But what we're doing here is we are assembling and reconciling, and this is just a shocking number, 1,000 mortgagee letters, 1,000 pieces of guidance, for those of you who aren't in FHA land, 1,000 pieces of guidance that are out there, some of them that are out of date. We are consolidating those into one authoritative place, into one handbook. We're going to have a draft of a first big chunk of this available very soon as next week, and it will be available for feedback. We're going to go through a process, get some feedback, try to turn it around relatively quickly, get it out into the marketplace, and then have it give time before it becomes effective so that everybody can adjust. But we think this is going to really help improve long-term access to credit by providing, again, more certain rules of the road for our lenders. And that is going to go hand in hand with changes that we're making, again, in an engaged process with lenders and stakeholders on how we do quality assurance moving forward, how we do it more quickly, how we provide greater certainty around what is a material defect in the quote-unquote manufacturing process of that loan. And we want to get feedback on that, and we want to get to a place where we can have a much better, faster, simplified quality assurance process that every lender can rely on. And if they can rely on that, then my view is we will see some expansion in the availability of credit, lifting what we like to call credit overlays, so that people are more comfortable lending to the credit box that FHA enables them to do. So we're working all this. We would like to hope that we can be a little bit of a, I don't want to say pioneer, but a leader in this particular area, and that perhaps FHFA and the GSEs will also be working on this kind of change to provide more credit access moving forward. So last thing I will say about what we're doing right now is all of these changes clearly are reducing our footprint in the market as we speak, returning to more normal time volumes for FHA, while hopefully not unduly restricting access to credit. And our increase in premiums and our other policies, along with higher interest rates, clearly have resulted in a reduction in FHA volume moving forward. And I would say it is clear to me that we have reached the tipping point in those policies, and it's important that we recognize that in terms of not ongoing restriction of credit to the expense of getting the volume down even further. We are at a volume point for FHA today where we are at pre-crisis volumes. Now, our market share has also dropped significantly from its peak. It's still higher than it was just before the crisis, but in terms of our actual volumes, we've dropped. It's that the rest of the market hasn't come back in to create a larger market. So we're going to continue to be a player. We think that's important for borrowers and for communities, but we want to be sure that we're doing it in a stronger, safer housing finance system. And we're going to make substantial changes along the way. We already have, and we think that there are additional changes clearly that need to be made in the housing finance system. So I just want to say, let's take a step back and talk about that, the principles of housing finance reform, and then go back to a little bit in terms of how FHA fits into that. So you all know that in August, the president introduced 4 goals that must be met from the administration's perspective in looking at housing finance reform and getting it done the right way. First, we need to wind down the GSEs and signal that taxpayers will not be on the hook for the behavior of the private industry. Private capital should bear the substantial majority of losses, and government's role, however it's crafted, should be transparent explicit, and appropriately priced. Now, the GSEs are already reducing their retained portfolios. They're experimenting, as you know, with risk-sharing structures and actions that reduce government support for the housing industry in the current situation. The private industry now has to be ready to, willing to step up and take more risk as the GSE's roles recede. As I've said, second, private capital needs to be the lead in the mortgage market. There are two supporting roles for government. The first is behind private capital in a reformed system, and the second is to borrowers that would not otherwise be served by the private market, which brings us back to FHA, VA, and USDA. We think there's an important role there for the ongoing role of government. Third, we need to create a path to the middle class by keeping home ownership affordable. So affordability is part of the goals, especially for first-time homebuyers, and ensuring broad supply of quality, affordable rental housing. And that ties to the third part of the principle of preserving access to the 30-year mortgage, as well as multifamily options that produce rental housing at an affordable price. So this means that we need rules and standards that promote safe, transparent, and competitive marketplace, and that these goals will provide liquidity to the housing finance system, especially in times of economic stress. So that raises some interesting questions that need to be dealt with, and I just want to bring up a couple of them that are on our minds. The first is, how do you preserve a mechanism that plays an appropriate countercyclical role? So whether it's FHA and/or in a reform system, there have been some proposals, for example, to have automatic triggers when the economy gets to certain negative places. And what's interesting about this is when you think about FHA's countercyclical role during this crisis, we had a natural role to play just continuing to do what we were doing. But it actually took Congress to raise loan limits to enable the government, both FHA and other agencies and the GSEs, to make a broader access available because there was no capital in that space at that time. But it took congressional action. And so do we want to rely on needing congressional action next time there is a crisis? And hopefully there won't be a next time of a crisis that's this severe. So thinking about, automatic triggers like that for certain activities is one area I think is important. Back to FHA and how FHA would fit into this broader housing finance system. We have overcome some serious obstacles throughout this crisis, and we are committed as an administration to work on a bipartisan basis to create this safe housing finance system that we need to have moving forward. But what is not necessary at this point is to restrict FHA's ability to perform its dual mission in response to perceived risk. It is important that FHA continue to be able to do its dual mission and serve both countercyclical as well as underserved borrowers at the appropriate time. So I want to make sure that we learn the right lessons from this crisis and not the wrong lessons of unduly restricting access to credit. So we know that reform needs to be comprehensive. It needs to include both the government agencies as well as how the private sector interacts. And we know that that means that FHA's footprint should generally shrink, and there should be more government role as part of a catastrophic risk behind the new housing finance system. Having said all that, I would say this. There are very important reforms to FHA that need to happen so that we can manage our risk moving forward within this new system properly. We need the right tools. The recession has shown that the day-to-day hurdles make it harder for us to be effective than it should be. And so if we are going to participate in this kind of role moving forward, we need some changes to be able to quickly respond to changes in a volatile housing market that are, frankly, not always compatible with waiting for legislative action or federal rulemaking process. And I see former Commissioner Montgomery over there. First, when programs are running high losses because of changes to the market, we need to be able to step in quickly and effectively. The additional losses incurred while waiting for regulatory and ultimately legislative changes to the home equity conversion program, our reverse mortgage program, and the seller-funded down payment assistance program put the fund at risk. We would not be standing here talking about a $1.7 billion draw from Treasury had it not been for those two programs. Congress can and should provide FHA with the authority to quickly issue interim rules using a mortgagee letter as opposed to going through the 18-month rulemaking process when FHA sees emerging risks, documents those emerging risks. We need the authority to be able to act while we go through the rulemaking process. Second, we need to be able to identify and manage risks to the fund better than we can today. 3 years ago, only 3 years ago in FHA's 80-year history, this administration introduced an Office of Risk Management to do just that. But to take ownership of this process, the Risk Office needs specialized staff. In fact, Stan, I would like to steal some of your very knowledgeable and worthy economists to come work at FHA. Maybe we can have a little internship program. But seriously, we need to be able to attract and retain quality professionals, PhD economists, people who can really engage in the work of risk management in this complex system that we have. And so I know sometimes people think it's maybe outrageous in this environment, but I am not only going to just suggest this, I'm going to say it's absolutely essential that FHA, not for our entire governmental staff, but for specialized positions, absolutely needs the ability to move those employees onto what's called the FHA pay scale, so the higher pay scale that financial regulators are enabled to pay their staff. FHFA has this authority, as do many other agencies, and so it is unconscionable, in my view, to not have this kind of help and be able to retain this kind of staff given the portfolio that we have and the work that we have in front of us. So that is something that we feel is very important. The last tool is the budget is constrained by, the FHA budget is constrained by the appropriations process. All you have to do is witness the government shutdown, making it difficult for us to access the resources, support, and expertise that we need during times of economic crisis when our portfolio ramps up and in response to new risks and opportunities. So the third tool we need is greater control over our resources, and we need to do this some administratively, but also legislatively. In a budget environment where we're stretching every dollar, these three new tools are critical if FHA is going to play the appropriate role it needs to in a reformed housing finance system. So I think there should be bipartisan support for FHA, giving FHA these tools that enable us to step back and focus on our underserved markets when it's appropriate and ramp up and provide countercyclical force in tough times. So I'm going to end by saying I know that everyone in this room shares the belief that housing finance is too important to get pushed aside for the crisis of the day. And right now, there is an urgency that needs to be harnessed, or My fear is there's a risk of getting too mired or too comfortable in this status quo. We have to make our housing finance system stronger, safer, and more fair, and the opportunity is now, and it's too valuable to waste. We have, great bipartisan efforts going on, and we need to capitalize on those efforts and really, push this home in an urgent way over the next several months. Clearly, a rock-solid housing market is the foundation for the middle class and an engine to keep the country on the road to full economic recovery. And getting housing finance done and done right, we know won't be easy, but as a mentor of mine used to say, if it was easy, someone else would have done it by now. So it's up to all of us to roll up our sleeves, engage in this conversation, and really work hard to get this done, because supporting the housing market and making the American dream a reality for millions of families is simply too important. So on that note, I'd stop, take a breath, and be happy to answer any questions that you might have. I know I am between you and lunch.
Hi, I'll be real quick. Fred Glick. I was up here before. I'm over here.
Okay.
Quick question. As a mortgage broker and on the street and real estate broker, why isn't it that you can just increase the upfront mortgage insurance that's financed into the loan and reduce the monthly? It's killing us, and it's making FHA unaffordable, especially the fact that the 3% down from Fannie and Freddie is going away in November 15th. Can you talk about that and maybe help us?
So let me tackle it at a broad level, which is to say, it goes back to the balancing act I've been talking about. We entered this situation with a mortgage insurance premium that was legislatively capped at 55 basis points. Clearly, 55 basis points was not accounting for the risks that we had been taking on, not even considering the crisis. So there has been a lot of work that has needed to be done to increase those mortgage insurance premiums, to change policies, to tighten up some of our credit policies at the lower end of the credit scale, and we've taken all of those actions. So when I say we're at the tipping point, part of what I'm saying is I am acknowledging and feel your pain, so to speak, that we are at a point where I do believe we've reached the tipping point where FHA is becoming too hard to access and too expensive. At the same time, we have needed to do those things to ensure that we are appropriately pricing our risk and putting FHA on the right track for the future. We can get into a whole debate of whether upfront premiums or annual premiums are better from a risk management standpoint for the fund versus better for the borrowers and access on the other hand. And I think, so far our view has been that having it on an annual basis is better for the fund in terms of its long-term stability. Having said that, the last thing I'll say, and I have a habit of answering questions too long, but I do think it's time for FHA to be looking, at where we are coming out of the crisis, where we're going to be in January. As I said, our portfolio is much, much better. Our new books of business are clearly much safer. So it is time for us to dig in and look at some of these policies more closely.
Thank you.
Commissioner Galante, over here to your left. So I had two quick questions. One, you talked a lot about the credit overlays. I was wondering, with the recent raise in rates where a lot of the refi activity for originators have gone away, and there's an economic pressure to make sure you maintain some levels, have you seen lenders being more willing to remove some of those overlays? And then the second question is a little bit on the MMIF fund. A large driver of that was the HECM program, the losses there. You recently got some new authority to make changes. Can you outline kind of what we should be watching for in terms of changes to that program and how that will impact the market?
Sure. So the first question in terms of are we seeing, now that the refi boom is slowed down, seeing some different behavior by lenders on the credit overlays. I would say anecdotally we're starting to see it, but I don't have enough evidence at this point that it's substantial. I will say that even before that, even before the refi bust or boom kind of slowed down, we were already starting to see at FHA, the average credit score go down just a bit. So I think we were over 700 for a couple of years. Our average credit score recently was 690. So, it is starting to shift. Part of that might be change in credit overlays. I think most of it is that FHA is losing the top, the higher FICO score borrowers to the MI business right now. And again, people say to me, are you concerned about that? And my answer is no. I now believe we are priced appropriately for the kind of mix that we're serving. And so I'm okay with that. But we have to watch the credit overlays data come in over the next few months probably before I could give you a definitive answer on what's causing that. On the reverse mortgage program, I think the rules that we put out with the help of Congress, which we very much appreciate, you are going to see, again, more focus on housing counseling, financial assessments, actually looking at the borrower's ability over the long term to sustain this reverse mortgage as well as sustain their property taxes and insurance. So there is an new underwriting component, I think, that is the most significant part of the changes in the reverse mortgage program.
Thanks.